In June 2012, the Monti government approved a bill for growth which aimed to open the country's dormant economy to competition and foreign investment. 11 months later, Monti has been ditched by voters, but the new regulation has started to reshape the Italian debt market. Several Italian corporates have knocked at the door of high-yield investors to refinance bank debt, and the new restructuring laws have aligned Italy's legal landscape with the rest of Europe. But the risk of a political impasse remains high, and more reforms are needed before Italy can come in from the periphery. Antonella Pagano, partner at PwC in Milan, joins me today to assess progress on this front. Antonella, is Italy now a better place for investment compared to a year ago?
Good morning. It should be. It is expected to be because first of all, we finally have a new government, which is the first step which is necessary to carry on with the reforms that Mr. Monti started to implement. Now we have to work a lot on the growth and on somehow creating a better environment for the Italian companies and for the investors as well. I think that stabilization is really important also for investors willing to come to Italy. Because if we look at what happened over the last year and a half, most of the investors specialized in distressed assets were more focused on other countries, like apart from the UK, but also in the rest of Europe, in Spain, for example. I think that things are now moving, and again, we need to give a clear sign that reforms are in place just to give a better environment for investors too.
To go into details, the market of non-performing loans in Italy has been almost underdeveloped in the last few years compared to the rest of Europe. Is it now finally catching up?
It seems to be. There are some signs that things are moving, and in particular, what we see is that some of the investors that spent most of their time in Spain, for example, last year, are finally looking at Italy too. And this is a combination of various factors. First of all, because Italy is a big market for NPL. So we have almost 200 billion euros of non-performing assets in the books of Italian banks. Then because the level of provisioning in the books of the banks has been going up recently. So we expect that the bid and ask gap, which created some problems to the deals in the past, is somehow reducing. And this, combined to a bit more stabilization in the Italian system, should represent a good incentive for investors. And we listen to a lot of new investors knocking to our doors, so we believe so.
And looking at the more typical distressed restructuring side, are the same international investors now looking at Italy with more interest, or the situation is still difficult?
They are looking, as you said before, we now have a new legal environment which is supposed to create a better environment for investors willing to take also single name positions, so as part of restructuring. And some of the investors that invest in non-performing loans portfolios are also interested in single names. So somehow the market of restructuring could work in parallel with the proper NPL portfolio market.